Preparing for a finance manager at SoftBank interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to join SoftBank as a finance manager? SoftBank appeals to me because finance sits close to major technology and investment decisions. I would bring strong budgeting, reporting, valuation, and stakeholder management skills to a business spanning operating companies, funds, and international markets. The role also offers meaningful complexity, fair value judgments, foreign exchange, liquidity, and rapidly changing portfolio assumptions. I am motivated by building reliable finance processes that help leadership act decisively while preserving transparency, challenge, and control. While answering, connect your finance leadership experience to SoftBank's technology investment model, global footprint, entrepreneurial culture, portfolio complexity, and need for disciplined analysis, forecasting, governance, and communication. Question 2. What do you understand about SoftBank's business model? SoftBank is a technology-focused investment group with exposure through telecommunications, strategic holdings, and investment vehicles such as its vision funds. Its results therefore combine recurring operating earnings with realized gains, unrealized valuation movements, financing costs, and foreign exchange effects. I would analyze each layer separately before assessing consolidated performance. That distinction matters because a strong operating quarter can coexist with portfolio volatility, and management needs both views for sound capital allocation. Make sure to cover SoftBank's technology investment strategy, telecommunications and operating businesses, investment funds, portfolio company exposure, holding company structure, and why finance must distinguish operating performance from investment valuation. Question 3. How would you build a monthly forecast for a SoftBank investment portfolio? I would begin with an exposure inventory by asset, fund, geography, currency, ownership percentage, and accounting treatment. Then I would load actual results, obtain updated company metrics, and model valuation drivers such as revenue growth, margins, comparable multiples, funding rounds, and exits. I would produce base, upside, and downside cases, document assumptions, and reconcile changes against the prior forecast. Finally, I would review outputs with investment teams and clearly separate operating assumptions from market-driven valuation movements. In your answer, talk about portfolio segmentation, actuals, management assumptions, valuation drivers, ownership changes, FX, scenario ranges, forecast governance, and reconciliation to prior forecasts and reported results. Question 4. How would you assess whether a portfolio company's valuation is reasonable? I would triangulate rather than rely on one method. For a mature company, I would compare discounted cash flow results with public company multiples and relevant transactions. For an early-stage investment, I would emphasize the latest financing, milestone progress, cash runway, and comparable funding evidence. I would test revenue, margin, discount rate, and multiple sensitivities, investigate significant movements, and document why the selected valuation remains supportable under current market conditions. Be sure to mention valuation methodology, recent financing rounds, comparable companies, discounted cash flow analysis, market conditions, liquidity discounts, sensitivity testing, and independent challenge of management assumptions. Question 5. Explain how you would analyze an impairment indicator for an investment. I would first identify indicators such as a failed funding round, declining operating performance, liquidity stress, regulatory disruption, or a sustained market value decline. I would then compare carrying value with updated fair value or recoverable amount, depending on the applicable standard. The analysis would include forecasts, financing prospects, comparable company evidence, and sensitivity testing. I would involve valuation and accounting specialists where judgment is material, then document the trigger, evidence, conclusion, and approval. Focus on identifying triggering events, distinguishing temporary market volatility from sustained deterioration, assessing recoverable value, testing assumptions, escalating judgmental items, and documenting conclusions under the applicable accounting framework. Question 6. How do you distinguish operating performance from investment gains and losses? I separate recurring operating performance from investment and financing effects. Operating analysis includes revenue, costs, margins, and cash generation from businesses such as telecommunications or other operating subsidiaries. Investment analysis separately captures realized disposals, unrealized fair value changes, dividends, and impairment. I also isolate interest and foreign exchange. This bridge prevents market movements from obscuring underlying execution and gives management a clearer basis for budgeting, accountability, and capital allocation decisions. Make sure to cover recurring revenue and expenses, EBITDA or operating profit, realized gains, unrealized fair value movements, financing effects, FX, and the importance of consistent management reporting. Question 7. What would you include in a board-level finance pack? A board pack should prioritize decisions, not volume. I would include headline financial performance, cash and liquidity, debt maturity profile, investment activity, portfolio valuation movements, leverage, and key operating KPIs. Each section would show actuals versus budget, prior period, and forecast, with concise explanations for material variances. I would add downside scenarios, covenant headroom, major risks, and proposed actions. Complex valuation or accounting judgments should be summarized clearly with supporting detail available separately. In your answer, talk about concise KPIs, actual versus budget analysis, liquidity, leverage, portfolio valuation, major risks, scenario analysis, key decisions, and clear explanations of material movements. Question 8. How would you manage foreign exchange risk in SoftBank's global portfolio? I would map exposures by currency, entity, instrument, and reporting line, distinguishing transaction risk from translation risk. Then I would quantify sensitivity to relevant exchange rate movements and identify natural offsets, such as foreign currency assets matched with liabilities. Where appropriate, I would evaluate forwards or other hedges against policy limits and cost. Reporting should separately show constant currency performance, actual FX impact, and hedge results so leadership understands economic and accounting effects. Cover exposure mapping, transaction and translation risk, natural hedges, sensitivity analysis, hedging instruments, policy limits, accounting effects, and communication of FX-driven versus business-driven performance. Question 9. Describe your approach to variance analysis. I start by defining materiality and separating controllable from market-driven movements. For revenue, I analyze volume, price, mix, timing, and currency. For costs, I examine headcount, rates, utilization, and one-time items. For investment results, I isolate ownership changes, market multiples, operating revisions, and FX. I validate explanations with business owners, quantify the full bridge, and turn recurring unfavorable variances into forecast or control actions with named owners and deadlines. Be sure to mention materiality thresholds, price volume mix or driver-based analysis, recurring versus non-recurring items, ownership and FX effects, root causes, actions, and follow-up accountability. Question 10. How would you improve a budgeting process that is consistently inaccurate? I would diagnose whether errors arise from weak drivers, optimistic assumptions, timing, poor data, or ownership gaps. Next, I would replace unsupported top-down percentages with driver-based assumptions, such as subscribers, headcount, investment pace, or portfolio exits. I would introduce monthly rolling forecasts, scenario ranges, and a documented assumptions log. Forecast accuracy should be measured by line item and owner, with post-period reviews focused on learning rather than blame. That process improves credibility and decision usefulness. Focus on diagnosing forecast bias, using driver-based models, involving operating owners, separating commitments from assumptions, introducing rolling forecasts, measuring accuracy, and preserving accountability without creating excessive bureaucracy. Question 11. Tell me about a time you found a material reporting error. In a prior role, I noticed that an intercompany balance did not reconcile before month-end close. I traced the difference to a currency conversion applied in one entity but not the other, quantified the reporting impact, and alerted the controller immediately. We corrected the entry, documented the judgment, and assessed whether any prior periods were affected. I then added an automated reconciliation and a review checklist, reducing close exceptions and preventing recurrence. In your answer, use a concise star. Question 12. How do you ensure accuracy during a high-pressure month-end close? I use a close calendar with dependencies, owners, deadlines, and escalation points. Critical balances receive early reconciliations, while automated validation checks flag unusual movements, missing data, and intercompany breaks. I prioritize high-risk areas such as investments, debt, provisions, and foreign exchange rather than applying identical review effort everywhere. Late adjustments require clear evidence and approval. After close, I review recurring bottlenecks and convert them into process or system improvements for the next cycle. Mention a close calendar, responsibility matrix, materiality-based review, reconciliations, automated checks, issue escalation, late entry governance, and post-close lessons learned. Question 13. How would you evaluate a proposed technology investment financially? I would assess both strategic fit and financial return. The analysis would cover market size, growth, competitive position, unit economics, cash runway, funding needs, valuation, dilution, and plausible exit paths. I would model base, downside, and upside outcomes using probability-weighted returns, then test sensitivity to growth, margins, financing, and exit multiples. I would also evaluate governance rights and capital alternatives. A compelling investment needs attractive risk-adjusted returns, not merely an exciting narrative. Cover strategic fit, market size, unit economics, cash runway, valuation, return scenarios, dilution, exit assumptions, risks, governance rights, and comparison with alternative uses of capital. Question 14. What financial metrics would you monitor for a venture-backed portfolio company? I would tailor metrics to the company's stage, but generally monitor recurring revenue growth, gross margin, bookings, retention, customer acquisition cost, lifetime value, monthly cash burn, and runway. I would compare growth with efficiency using metrics such as the Rule of 40 where relevant. I would also track funding milestones, hiring, product delivery, and competitive developments. Financial metrics matter most when connected to operating milestones and the timing of required capital. Be sure to mention revenue growth, gross margin, burn rate, runway, customer retention, acquisition cost, lifetime value, bookings, cash conversion, funding needs, and milestone progress. Question 15. How would you assess liquidity and capital allocation at a holding company? I would build a rolling liquidity forecast covering cash balances, operating inflows, debt service, maturities, capital calls, investments, dividends, and potential disposals. I would stress test market declines, delayed exits, weaker operating cash flow, and refinancing constraints. The analysis should show available liquidity, committed but unfunded obligations, covenant headroom, and optionality. Capital allocation would then rank debt reduction, strategic investment, shareholder returns, and reserves according to risk-adjusted value and liquidity resilience. Focus on cash sources and uses, debt maturities, committed investments, dividends, collateral, covenant headroom, stress scenarios, refinancing risk, and prioritization of strategic opportunities. Question 16. How would you account for a portfolio company where SoftBank has significant influence? I would first assess the rights and facts: voting power, board representation, shareholder agreements, dispersed ownership, and decision-making authority. Those facts determine whether the investment is consolidated, accounted for under the equity method, or measured at fair value under the applicable framework. I would document the conclusion, monitor changes in ownership or governance rights, and coordinate with technical accounting specialists. The key is treating legal ownership percentage as evidence, not the sole determinant. Discuss assessing control and influence, applicable accounting treatment, ownership rights, equity method implications, fair value alternatives where relevant, consolidation boundaries, and coordination with accounting policy experts. Question 17. What controls would you establish over investment valuation reporting? I would establish a valuation calendar, asset owner responsibilities, approved methodologies, and clear review thresholds. Inputs should come from controlled sources, with independent checks against market data, financing evidence, and portfolio company reporting. Model changes require documented approval, while valuation adjustments receive review separate from the preparer. I would retain assumptions, calculations, sensitivities, and evidence in an auditable repository. Periodic backtesting against realized exits would help identify persistent bias or methodology weaknesses. Mention data ownership, valuation calendars, independent price checks, model validation, approval thresholds, source documentation, segregation of duties, sensitivity review, and audit trails for changes. Question 18. How do you work with auditors on complex accounting judgments? I engage auditors early on material or novel issues rather than presenting a conclusion at the deadline. I prepare a balanced memo covering the facts, relevant guidance, alternatives considered, quantitative impact, and proposed treatment. I involve accounting policy, valuation, legal, and business stakeholders as needed, while keeping roles clear. If views differ, I focus on evidence and standards, escalate through the agreed governance route, and ensure the final judgment is fully documented. In your answer, cover early engagement, issue framing, authoritative guidance, evidence, alternative views, materiality, documentation, internal alignment, and timely resolution without compromising independence. Question 19. Describe a difficult stakeholder situation and how you handled it. A business leader once challenged a forecast adjustment because it reduced the reported outlook. I first listened to understand the commercial context, then walked through the supporting data and assumptions. We agreed on which items were committed, probable, and speculative, and presented a range rather than disguising uncertainty. The leader accepted the conclusion because the process was transparent and solution-oriented. I preserved the relationship while maintaining an accurate forecast and clear decision trail. Use STAR, emphasizing listening, objective evidence, respectful challenge, alignment on decision criteria, timely escalation, and maintaining the relationship while protecting reporting quality. Question 20. How would you explain a complex valuation movement to a non-finance executive? I would begin with the headline. The portfolio value changed by a specific amount, but the movement may not represent cash received or paid. I would use a simple bridge separating operating performance, market multiples, financing events, ownership changes, and FX. For example, stronger revenue may increase value while lower sector multiples offset it. I would then explain confidence levels, sensitivities, and any decision implications, avoiding technical terminology unless it improves understanding. Focus on plain language, separating operational and market drivers, using a bridge or example, quantifying the impact, explaining cash versus non-cash effects, and identifying implications for decisions. Question 21. What would you do if an investment team pressured you to use an aggressive valuation? I would ask the team to support the proposed valuation with observable evidence, approved methodology, and clearly defined assumptions. I would independently test the model, compare market data, assess sensitivities, and distinguish a commercial target from a reporting conclusion. If disagreement remained, I would document both views and escalate through valuation, accounting, and governance channels. Protecting integrity is essential. Short-term pressure cannot justify unsupported numbers or create audit and reputational risk. Be sure to mention independence, evidence-based challenge, approved methodology, sensitivity analysis, escalation protocols, documentation, audit implications, and separating commercial optimism from financial reporting conclusions. Question 22. How do you prioritize when multiple senior stakeholders need urgent analysis? I rank requests by decision impact, regulatory or liquidity risk, deadline credibility, and dependencies. A refinancing analysis or reporting issue would generally outrank a lower-risk presentation request. I clarify the decision required, minimum viable analysis, data availability, and timing with each stakeholder. Then I delegate where appropriate, communicate trade-offs early, and provide staged outputs rather than silent delays. This approach keeps urgent work moving without sacrificing quality or creating hidden control risks. Discuss assessing business impact, deadline credibility, regulatory and liquidity risk, dependencies, effort, transparent trade-offs, delegation, and communicating revised expectations early. Question 23. How would you use automation to improve finance processes? I would first map the process and remove unnecessary manual steps before automating it. High-value opportunities include data collection, intercompany matching, variance dashboards, valuation input validation, and recurring management reports. I would standardize definitions, test outputs against known results, restrict access, and retain review controls and audit trails. Success should be measured through shorter close time, fewer exceptions, improved accuracy, and better analyst capacity. Automation should strengthen judgment, not hide weak assumptions. Mention mapping the process first, standardizing data, automating reconciliations and reporting, preserving review controls, testing outputs, access governance, measurable benefits, and avoiding automation of flawed logic. Question 24. What is your approach to leading and developing a finance team? I set clear outcomes, decision rights, deadlines, and quality standards, then give people ownership rather than checking every step. I use regular one-to-ones to coach technical skills, communication, and judgment, and I create opportunities to present directly to stakeholders. During busy periods, I rebalance workloads and protect critical controls. I also give prompt, specific feedback and recognize strong work. A high-performing team should be accurate, commercially aware, and confident challenging assumptions. Focus on clear expectations, coaching, ownership, technical development, constructive challenge, workload planning, succession, psychological safety, and performance feedback tied to outcomes and behaviors. Question 25. What would your first 90 days as SoftBank Finance Manager look like? In the first month, I would learn the reporting structure, investment lifecycle, systems, close calendar, key stakeholders, and current pain points. In the second, I would test critical reconciliations, forecast drivers, valuation controls, and management reporting, while delivering a few practical improvements. By day 90, I would present a prioritized roadmap covering accuracy, automation, documentation, and team capability. I would align that roadmap with leadership priorities and establish measurable milestones rather than assuming change without evidence. In your answer, outline listening and stakeholder mapping, understanding reporting architecture, reviewing controls and forecasts, identifying quick wins, validating priorities, and building a practical improvement roadmap. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.